Okay, so we looked at buyback. I mean, $5.6 trillion. That's what's made the stock market. This is new money. This is shrink. This is leveraging stocks. It's companies taking money out of their strong cash flow in an artificial economy that would be much weaker without super low interest rates and all of this stimulus. It's affecting the upper class. And they're just shrinking their shares. It's leveraging. They are leveraging their own shares, which says two things, Jason. They're going to go up way faster, which that first chart showed how much they're overvalued, 120%, which means they're going to crash more when they come down. And all of a sudden, their stockholders are going to say 2 or 3, 4 years from now, oh, why aren't we buying our stocks back now that they're cheap? Oh, you know why? We spent all of our cash flow buying them when they were expensive. Companies now, I tell people it was the shoe shine boys, the dumb money, I
Right.
hate to
Yeah.
say it,
Yeah.
buying stocks in 29. It is the Fortune 500 executives and the richest people in this country, most buying stocks. Everyday people are not driving this stock bubble. I showed that. Oh, here's the next chart. It's not okay.
I got
There
a
it is.
question though before you move on about stock buybacks. A lot of people criticize stock buybacks, Harry, but I'm wondering, is it really that bad? I mean, when a company buys back its own stock, it's kind of doubling down, right? It's showing faith in itself, isn't it? Isn't that
Yeah,
isn't
yeah.
that a
So
good sign? Look,
here's
like
my question, Jason.
one of the metrics people look at is they look at what are the insiders doing, and if the insiders are selling, investors lose faith in that company. Here, essentially, with the buybacks, the insiders are buying. I mean, maybe it's the treasury account, but go ahead.
Yes, they're buying. If you're doing it in normal times, if you just like slowly over a boom like the 50s and 60s, bought a little more of your stock, yeah, you're just making a little more advantage, a little more leverage for things. When you buy into a bubble like this, and the steepest bubble in all of history, you're taking precious cash flow, which company, believe me, the companies in the 30s that survived a bubble crash of this level, the ones that survived were General Motors that had better cash flow and could get through it. The other ones went under. And so the surviving companies buy their assets for nothing, take over their customers. Cash flows everything. You're using your cash flow in a boom to leverage your stock and make it bubble like so it will crash more. And the worst consequence, you won't have that cash. In the downturn to survive and then to reinvest and leave your competitors in the rear view mirror. So yes, if you did it normally and over time and judiciously, it's just like it's like having a glass of wine a day. Most people say, oh, that's good for you. Relax a little bit. You have a couple bottles a day. No,
That's not
not
good,
a good practice.
right?
That's
Too
what this
much.
is. This is a couple of bottles in the
Okay.
late stages of the greatest bubble. And I'm just telling you, Jason, I'm saying this today so I can remind people a few years from now, these are going to look like the stupidest people in history that took their these successful companies took their shareholders' money and gambled it on their own stock, leveraging it up as if these stocks weren't doing okay as was, and basically screwed their shareholders.
Okay.
That's
Okay.
what it's going to look like.
Okay. So let's move on. That interestingly though will redistribute some wealth back into the middle, maybe.
Hey, yeah, yeah. Well, we don't need Bernie Sanders. This is going to be the fastest wealth redistribution from the rich to the everyday, just like in the 30s. The rich got richer in the 1929 and into 75. For many things, they lost some of their advantage in share of wealth and income. That's going to happen here very quickly in wealth.
Yeah. Very,
Because
very
Homer Simpson
interesting.
doesn't own this bubbly stuff, doesn't own
Right.
bubbly houses, and doesn't own a lot of bubbly stocks.
Okay. All right. Go ahead.
And then, okay, I mean, so I said the only people buying this one chart here shows the red line is corporations buying their own stocks. The blue line is foreigners, so just barely buying, but less so. The green line is households. They have not been buying into this bubble. They're scared to death. They got killed in the last bubble in 2008 and 9 when it
hmm
crashed 54% and they didn't know why. And then You got the purple line. That's the smart money, the institutional investors. They have not been buying. They don't see value
Hmm.
in this market getting so overvalued. So that's what's happening, and that's what's created this next chart. It just shows this is look
Okay, and we're
the
and we're still focused on the stock market, so we'll get to the
stock.
broader economy in
Good,
a
and I'll
moment
tell you
here.
why, Jason,
Yeah,
because the stock market is the best leading indicator
right.
of the
I
economy
agree.
and gets way more overvalued than real estate in a bubble. But real estate's in a bubble too, but it's more on the high end and in certain places,
Yeah,
as you
the
know.
cyclical markets. Yeah.
But the stock market is a good way to say, gosh, are we in a good place, or are we about to see the crash of a lifetime? And I'm making the argument we're about to see something worse than 2008 and 9. And we saw what happened to real estate and the economy and banks and in people underwater in mortgages, and what did well, like affordable housing and apartments versus what high-end houses,
Right.
and what did the worst, bubbly stocks.
Yeah, right. High-end houses are like high-flying.com stocks that
They
don't make any
are.
sense. They
They are.
they really have trouble in bad times. Harry, when you look at all of these charts and we talk about all of these crazy numbers, whether it be the QE numbers or debt numbers or stock buybacks or whatever, are these things adjusted for inflation? Like, we look the chart you're showing now dates it's showing
This
the
one's not.
first bubble. Yeah, okay, the first bubble in 1986, a minor bubble, and then another one in the mid to late 90s. That's the dot-com bubble, I guess, right?
That was the dot com
Yeah.
bubble,
And
and
then
that was
there's
considered, oh my gosh, huge bubble, and
right.
that,
And then there's the
not
post
compared to now.
9/11 bubble, okay, which
Yes.
was because of all that 9/11 stimulation, and now there's the stock market bubble we're in now.
Yes.
Yeah.
And,
Wow,
and,
that
and
is
so when somebody
staggering.
says, any analyst, for any reason, there's a million reasons, this is not a bubble, my response is, looks like a bubble, walks like a bubble, quacks like a bubble. It's a bubble. This
Yeah.
is this makes 1925 to 29 look like nothing. And look at it compared. Now, again, this is not the NASDAQ, which is more bubbly. This is the Dow. And compared to the bubble back in 95 to 2000. So again, that was a major bubble. We had a minor bubble before, not. And one of the reasons I use this chart also, Jason, I would tell people we have 4 seasons in the economy. The bubble boom is the fall season, like we saw in the early 1900s. And this, you expect bubbles. And just even though that 87 was a small bubble, there was a 40% crash in 2 weeks. That never happened in the entire 1942 to 1968 stock market boom. It wasn't a bubble boom. The corrections were 20%. They weren't 40, 50% here. I'm projecting 70 to 85% when this one blows. So again, the point here, though, forget all the complications and the stuff. If this stock bubble blows anywhere near what I'm saying, you know how much wealth disappears in the
Well,
economy?
well,
This
just
next, yeah.
just just the other day, when the stock market hit the first coronavirus scare, when it started paying attention to that, and then the following day it was also down. Literally everything was down. I can't remember the stat I read, but it was just a monumental amount of
What
money was just
one
wiped
point
out.
1.7 trillion in 2 days.
Wow,
That's what it was.
that's